I think the surprise here from the Australian Central Bank is that we didn't get any sense of an easing bias going forward, and perhaps that sort of ties into the sort of more bullish market reaction that we get today.
It's a fine balance, I think. They're trying to keep the market sort of on the dovish side. At the same time, you have GDP numbers which are quite good. At the same time, I think the key here is to look at other measures of the economy, like real incomes per capita are shrinking. It's been the case since early 2015. This is good, bad for domestic demand. That's why you're seeing inflation sort of ease more and more in the last 2 quarters. That was the RBA's reason for cutting last month. It was a rethink in the sense of how low rates can go in this cycle. I suspect we'll see more cuts at some point this year. It wasn't like a one-off move in May.
How big a concern is that inflation picture? Because as you said, I mean, the latest CPI reading 1.5% is significantly away from their 2 to 3% target, and it is filtering into wage expectations. We've seen wage rounds actually soften as well, which was a concern, and they mentioned that in the last report that they provided as well. At what point does that then feed into domestic demand and have a sort of kicker impact?
I think we're seeing this already. Demand domestically is quite weak. Investment is not picking up anytime soon. Consumption is financed out of savings, increasingly so.
And yet that growth reading was so strong. I mean, 4-year high, wasn't it, for the first quarter?
In a sense, the GDP number doesn't really account for terms of trade adjustments. So purchasing power moves are not seen in this number. And that's what is actually mirrored in the income measure. And that's why this gap between GDP and incomes per capita is widening. And that's what the RBA is seeing. And they're becoming more vigilant about it. I suspect they want to see the Q2 CPI number in late July. Elections early in July are also a risk, so I think they want to sort of wait for that to see what happens. And GDP itself, if you see the drivers, is not really strong. You have fiscal spending, which is not sustainable. You have exports, which are doing fine, but China, Japan, and Korea, the main partners of Australia's trade, are not doing that well. China is slowing, that's a big picture, and will remain so in the next years to come.
That's the conundrum, isn't it? That's the bit that is peculiar here, because the RBA has focused in on the property market, as you might expect them to do, but they've pointed out that a number of lenders are taking a more cautious attitude now to lending, and yet the market still feels very hot in key cities, even as you talk about some of the weakness in that demand for Australian commodities coming out of Southeast Asia and China, Greater China. So where does the rubber hit the road here? If you're looking to buy a property in prime Brisbane or Melbourne today, should you hold fire or should you pull the trigger?
I think it's a good question. I think rates are going lower. They are low and going lower. I think banks are now easing somewhat their standards. I think we're seeing loan-to-value ratios go up again. For me, it's going to keep going up. The pace, okay, it's debatable, but unless you see higher interest rates, this sort of bubble will keep going, and that's not on the cards anytime soon.